How did the Glass-Steagall Repeal change banking? Have you ever wondered how a single piece of legislation could reshape an entire industry? The repeal of the Glass-Steagall Act in 1999 did just that for the banking sector in the United States. This act, originally passed in 1933, aimed to stabilize the banking system during the Great Depression by keeping commercial banks separate from investment banks and insurance companies. When the Glass-Steagall Act was repealed through the Gramm-Leach-Bliley Act, it removed the legal barriers that had kept these financial services apart. This change allowed banks to combine activities like taking deposits, making loans, underwriting securities, and selling insurance all under one roof. As a result, we saw the rise of large financial holding companies that could offer a wide range of services to customers. Before the repeal, commercial banks primarily focused on traditional banking activities. They were not allowed to engage in riskier investment banking practices. This separation was designed to protect depositors from the risks associated with speculative investments. However, after the repeal, banks could cross-sell products, which meant they could offer everything from loans to investment advice, all in one place. This shift was made easier by advancements in technology. As data sharing became more efficient, banks could integrate their services more seamlessly. Other countries had already adopted universal banking models, which likely influenced the decision to repeal Glass-Steagall. However, the repeal was not without controversy. Critics argue that the blending of commercial and investment banking contributed to the financial crisis of 2007 to 2009. They believe that allowing banks to take on greater risks led to instability in the financial system. The emergence of large superbanks raised concerns about institutions being too big to fail, which created a moral hazard where banks might engage in riskier behavior, expecting government bailouts. On the other hand, supporters of the repeal argue that the financial crisis was caused by various factors unrelated to Glass-Steagall. They contend that the separation of banking activities was already weakening due to regulatory changes before 1999. They believe that the repeal allowed U.S. banks to compete more effectively on a global scale, offering a full suite of financial services. In practical terms, the repeal led to a more integrated financial industry. Financial holding companies emerged, operating across banking, securities, and insurance sectors. This integration encouraged innovation and product diversification, but also made regulatory oversight more challenging. While the law maintained some restrictions, it allowed for more experimentation within the financial sector. Looking back, the repeal of the Glass-Steagall Act marks a significant shift in the U.S. banking landscape. It reflects changing economic conditions and evolving views on financial regulation. The transformation has had lasting effects on how banks operate and manage risks, shaping our understanding of financial crises in the modern era.